Good morning, everyone, and welcome. I'm Matilda, and I will be hosting today's webinar. We're so glad you could join us as we dive into a really interesting topic: why smart investors do dumb VC deals, the 8 most common mistakes. Before we get started, here are a few quick things to know. This session is being recorded, and we will send the recording to you afterward. If you have any questions, just drop them in the chat box below. We will try to answer as many as we can during the Q&A session. And finally, don't forget to follow Expira on LinkedIn to keep up with future events and updates. Now it's my pleasure to introduce our speaker, Professor Douglas Abrams. Douglas is the founder and CEO of Expira Ventures. He's helped launch multiple funds and supported many startups globally since 2000. Besides leading Expira, Douglas is also an adjunct professor at the National University of Singapore, where he teaches both undergraduates and MBA students about venture capital and entrepreneurship. Douglas, thank you so much for being here today. I will hand it over to you now, and I will join you again for the Q&A.
Okay, thanks, Matilda, and thanks everybody for joining. I think everybody knows this, and this is contact information for me. Everybody can get copies of the slides after, so if you're interested to connect, we're not already connected, please feel free. Some history of Expira, which I think also most of our attendees will already know, and some highlights of our investment and acceleration programs over the last 21 years, where throughout Southeast Asia and launched in China, and this year also opening up in Middle East. I picked what I call my top 8 reasons that smart investors do dumb VC deals. The reason I decided to talk about this topic is there's so many webinars and seminars about how to do good investment and talk about what it is you should do, which I will get to, because when I talk about what you shouldn't do, I'll also talk about what you should do. But I wanted to focus this morning on most common avoidable mistakes that VC investors make. And these mistakes span different types of VC investors. It's not just, or based on my experience, it's not just new investors or angel investors or CVC investors or any specific subcategory of VC investor, but especially if you're relatively new to VC, I think this would be super helpful, because I try to focus on mistakes that are avoidable, or I think avoidable. And in VC, we talk about 2 types of investors. We call smart money and dumb money, and I think there's a lot about those terms. What we call dumb money investors in VC, actually, they can be very smart investors. Most of them are smart investors because they're coming to VC with money to invest that they made in other asset classes. So they're not dumb at all. They're smart people, and they're often very smart investors. But they tend to lose a lot of money in VC because they are not familiar with what investment is hard, is difficult. If it was easy, everybody would do it and everybody would be rich. But it's not. It's difficult to do successful investment. The most difficult asset class for investment is venture capital. It's more difficult than any other investment asset class. And that's not just opinion, it's based on data. Specifically, success rates of VC investment. Success rates of VC investment are much lower than success rate of investment in other asset class, if by a wide margin. So, okay, so let's jump in. First thing, we have to select the right companies. A lot of investors, I think, select, especially this is one I think is the thread that connects all these companies. In which way or what way are all these companies the same as one another, but different from other companies? And usually first response is, oh, they're all tech companies. They're not. Actually, there are a lot of tech companies, predominant tech companies, but there's some non-tech like Starbucks, Staples, Home Depot, which you'll know if you're from US or not, a coffee shop, hardware chain, and stationery store chain. But then they're all from the US, but true, how are they different from other US companies? And the point I want to make with this slide is that the key to selecting successful VC investments is each of these companies raised venture capital at some point, and many of them early in their life, and subsequently became number one in their product category in their market. Now, a lot of them are no longer number one, maybe even gone, but at some point they were number one in their product category in their market, not number two or number three or number N. So this is the first challenge, and I think key success metric for investing in startup as a VC. We want to invest in companies who have the potential to become number one in their product category in their market. And that's why you shouldn't be investing in companies that are going to be number N. There's already 10 successful companies in this product category in this market, and you're investing in the company that maybe, if they're successful, can become number 11. This already guaranteed to be a failing investment. Because why? This will become more obvious when I start talking about exits that will become number one in their product categories in their markets within the next 5 to 10 years. And if you're not doing that when you're looking at investments, then you already failed. Then there's no way you're going to extract required return from your investments. Of course, these are all what we would call scalable companies. This is almost the definition of scalability, because in order where they are now, very early stage company to number one in their product category in their market is going to require huge scalability over the next 5 to 10 years. Product versus service. Only product related companies, only product driven companies scale like this. So okay, so product versus service driven companies. We can't invest in SMEs and make successful VC investments. We have to invest in high growth startup. Well, let's say we selected the right company. What about the right market? We can select the company in the wrong market. I see a lot of VC investors selecting wrong what I would say wrong geographical markets, wrong sector, markets that don't have sufficient growth rate, and markets in which the investment is not. So what are most common drivers of the wrong market mistake? Actually, I think wrong market and wrong sector mistakes are driven by pretty much the same motivation, which is crowd following. So a lot of VC invest in whatever is the hot geography of the day. So rush to follow the crowd into wherever everybody else is investing. And this can be FOMO, fear of missing out. But unless you're a already huge venture capital fund, I think this is a terrible mistake, because the fact that the geography is hot means a lot of other investors are already in the market, and means you're going to be, again, just like we want to invest in companies that have potential to be number one in their product category in the market. I think us as investors, we want to be in markets where we can be a market leader rather than crowd follower. If you're a crowd follower, again, how to generate even average returns in that market. So another subcategory of driving that mistake is just focus on markets with a lot of people. You know, there's a huge number of people in this market, and therefore we should invest in startups that are targeting markets with a huge number of people. I mean, that sounds maybe makes a little bit of sense, but it doesn't work from how does this really help the company to generate required return? Just because the market is big and has a lot of people in it doesn't mean that the company is going to be successful there. Again, it can be the opposite. The market is big, it has a lot of people, everybody knows that, therefore everybody's trying to serve that market, therefore the startup that you're investing in has no chance of becoming number one in its product category in its market. Same thing with sectors. Everybody is investing in AI, so you need to invest in AI too. Of course, everybody knows now that that everybody's investing in AI, so everybody rushing to follow into AI is not going to make money on vast majority of their deals. Now, I think you need to, from a both geography and sector perspective, you want to look at what are the geographies and sectors that everybody else is not investing in right now, because they haven't identified the opportunity in that market yet. From example, Expira experience and again, actually all the things that I talk about in these slides, they're not just like theoretical mistakes or things to do that I use to talk about in webinars, but they drive our strategy and the decisions that we make in our company. So 2015, Expira was already established in Singapore, in Thailand, and at that time in Malaysia, and looking for a next market. And if you recall, 2015, most VCs in Southeast Asia go into Indonesia. So when we looked at Indonesia, we felt like already too late, already way too many VCs in Indonesia. So we went to Vietnam because nobody was looking at Vietnam in 2015, and we got a lot of questions about why we're going to Vietnam. Now, almost 10 years later, we're well established in Vietnam, very bullish on Vietnam. We've had a lot of interesting investments there, and now I think investors starting to take note of Vietnam. On the sector side, those of you who know about Expira will know our most successful investment, 2C2P, e-commerce, m-commerce payment provider, originally founded in Thailand and moved to Singapore, then became market leader in Southeast Asia, number one in their product category in their market, and then exit in a trade sale to Ant Financial in 2022 for more than $500 million US. And when we invested in that company in 2008, most of my friends, investors, were very skeptical. Why investing in payment? Payment is so boring. Payment is so yesterday, or even 10 years ago. You should be investing in iPhone apps because it's 2008 and iPhone had just launched. But we felt there was huge potential in the company and the founder. We were very founder focused. And 10 years later, fintech, everybody wanted to invest in fintech. And later, the company was already a huge success by then. So I always get a lot of questions from investors or people interested in VC investment. What are the most interesting sectors to invest in today? And I always like to say, the most interesting sectors to invest in today are the sectors that you haven't even heard about. All the sectors that you know are hot now, they're already not interesting, especially for early stage VC investment, because that means everybody's figured it out already, which means the deals are going to be way overpriced. Moving to wrong valuation. So this one, I think, is somewhat different from the first two, because first two is about selecting the right investment. This is and actually select wrong investment. Actually, we're going to do sometimes. You can't select the perfect investment every time. And I think this is a cost of doing venture capital business. We're going to hopefully select mostly right investment. When I say right investment, I mean investments that have the potential to achieve required return and to become number one in their product category in the market, like talked about earlier. But in every portfolio, we're going to, no matter how rigorous your sourcing and screening methods are, going to end up with some selected that we probably in retrospect shouldn't have selected, because that process of selecting right investments depends on what's going to happen in the future to some degree. So we can still do the best job that we can at that time and end up with some companies in portfolio that probably shouldn't have been there. But invest at the wrong valuation should never happen, because this is 100% avoidable mistake. Once we decide to invest in a company, we should only invest in it at the right valuation. And there is a right valuation, I strongly believe. I don't think that it's impossible. I don't think it's a debatable or impossible to calculate what's the right valuation. And I always say, I feel that if you think about what are some mistakes that we as venture capital investors could make, one is, we invest in the wrong company. Two is we invest in the right company at the wrong valuation. So which is bigger mistake? I would say invest in the right company at the wrong valuation, because wrong valuation is avoidable mistake. So how do we avoid investing at a wrong valuation and invest in right valuation? I think answer very straightforward. We have to first recognize that traditional valuation methods fail for startups. Why, especially early stage? Just to be clear, Expire does early stage. So when I talk about startups here, I'm talking about early stage startups. So pre-seed, seed, post-seed, or pre-series A, not growth stage or pre-IPO startups. So traditional valuation methods going to fail for all these startups, because traditional valuation methods assume that companies create value for shareholders in two ways: through capital appreciation and dividends. Creating value through capital appreciation and dividends are diametrically opposed, meaning those two methods of shareholder value creation are inversely related. Startups only create value for investors through capital appreciation. And second reason that traditional valuation methods fail for startups is that the ones that could be used, despite the fact that startups have different value creation method for shareholders, also assume that the startup generates value for shareholders through profitability, bottom line, rather than top line. The vast majority of successful startups generate value for shareholders through trade sales, and trade sales are almost always priced on revenue multiples. So successful startups, meaning startups that deliver required return for investors, will be generating value for shareholders through trade sale exits based on their top line, which means that we need to do our valuation, use a valuation method that takes account of that value creation method for shareholders. And the only valuation method that does this is VC method. So I can't go into how VC method works on this webinar, but we have online courses about this if you're interested to get more detail, or happy to talk about that in a subsequent discussion. But basically, the way that VC method works is exit valuation determines current valuation. This means that we basically, very simple way to look at it, we just divide exit valuation by required return, adjusted for dilution post-investment, and that gives us the current valuation. And the reason I think I say that so many investors invest at wrong valuation is when I look at the valuations that they're coming up with, there's no way that they're generated by this method. They're generated by some other method, which I call the hopes and dreams, or the wishes method, which I don't believe is the way is a correct valuation for startup, especially if you're investing other people's money. If you're managing money and you're using a method like that, I think that that's not executing your fiduciary duty to your investors. Another thing that drives a lot of overvaluation, so this is, I think, one factor that drives especially overvaluation in startup. A lot of the wrong valuations I see, I would say most of the wrong valuations I see are overvaluations. And I think what drives that, in addition to not using proper valuation method, is what I talked about in previous slide, chasing the deals that everybody else is chasing. So again, your crowd following behavior, where you want to get into hot deals, and therefore you're willing to participate in auction or basically bid to acquire a hot deal or a place in a hot deal. I think this is wrong on so many levels, because if you think about win the auction, what does win the auction mean? Win the auction means you were the one at the table that was willing to pay the most for whatever's being auctioned. So we have a saying in poker, if you don't know who is the dumbest guy at the table, if you don't know, it's you. So in this case, yeah, you were the one that was willing to spend the most, and therefore you feel like you won. I don't feel like that's a win. I feel like invest at the highest possible valuation, you already lost. Couple of other mistakes, but more specific that I see using wrong discount rate and discounted cash flow valuations and factoring in freakish outliers into comparables. But these are a little more technical, so I won't spend too much time on that this morning because I want to move relatively quickly through the topics. Wrong exit strategy. Worst is no exit strategy. One of the first questions I ask every company before we invest, what's your exit strategy? And if the company does not have an exit strategy, then we shouldn't invest, because why? Our returns come 100% from exits. If the company has no exit strategy, this means the company's going to have no ROI, which means that we're investing without a hope of making a profit on this investment. The next biggest problem after no exit strategy is wrong exit strategy. So I talked to many entrepreneurs about their exit strategy. Everybody wants to do IPO, but instead of IPO, they should be focused on trade sale. There's no IPOs, or their IPOs are fantasy or a dream. Trade sales are the reality. This is of course, we know there are some IPOs, but the IPOs are a vanishingly small percentage of venture-funded exits. The data that I show on this side is from the U.S. market. Over the last 10 years, the US market has the most active, most vibrant IPO exits of any venture market in the world by a lot. In the US market, 90+% of venture funded exits are trade sales. So even in the US market, fewer than 10% of the exits are IPO exits. That means in Southeast Asia and other markets, the statistics are going to be even worse. So if you think about it this way, basically only about 3% of successful portfolios make it to big exits, and that drives 80 to 90% of VC fund returns. And out of that 3%, less than 10% are going to be IPOs, which means way less than 1%. So of total investments. So and if you open up this category to look at IPOs that are in regional markets, it's even worse, because the IPOs in regional markets have many disadvantages to trade sales. So what I always tell our entrepreneurs that we invest in, if you have a realistic shot to get to NASDAQ or New York Stock Exchange IPO, you can consider that at some point, but fundamental exit strategy should be trade sale. And average proceeds for trade sale for venture funded companies in 2024 is about 200 million USD. So that's a pretty good exit for venture funded startup in Southeast Asia. So next big mistake, insufficient portfolio diversification. And this is one that I find even the people that have been in VC for many years either don't consider this, or they invest as if they haven't fully considered this. So we know that the vast majority, typical investment portfolio in typical asset class will have a normal distribution of returns, or in more properly, they'll have something like a normal distribution with a skew to the right if they're doing a good job investing. But this means that the average investment in your portfolio will deliver the mean return or around the mean return, and that 2/3 of your investment return should be within 1 standard deviation of your mean, and 95% should be within 2 standard deviations of your mean. This is not how everybody knows at some level that this is not how venture fund returns are distributed. Venture fund returns are distributed according to what looks like a power law. And there's some debate, I think, whether it's technically a power law or not, but for all practical intents and purposes, the distribution looks like the power law. You can see that as the green line in the chart that's on my right. And what that means in plain language is that instead of the average investment in your portfolio having the mean distribution return, 80 to 90%, and in most cases, more than 90% of your portfolio is going to deliver less than 10% of your returns. And the rest of the return, vast majority return, is going to be delivered by 1, 2, or 3 investments in your portfolio. And you can see that in the pie chart, where this again is from a survey over 30 years of tens of thousands of VC deals in the US, that 49% go to zero, and another 25% return less than one time, which means that 74% of the investments are basically write-offs or are returning less than the original investment, and 3% are delivering more than 20x, which for this round, so this is a first non-seed round of funding, 30x is required return on capital for that stage of investment. So why do I say that? It seems like investors should know this, but don't invest as if they know it, is because they're investing in their diversification, in their diversified portfolio. They're investing as if they're going to get normally distributed returns, when in fact they're going to get, if they're lucky, power law distributed returns. And that's why we have to set such a high cost of capital. And that's why if we are investing with a wrong distribution expectation, we're already going to fail. We're already dead before we even start. This actually is hugely important for angel investors, because why? If 3% of your portfolio is driving, let's say 90% of your returns or more, that means you have to have at least 30 investments to have a statistically likely chance of generating any return. And this means if you're investing in a small number of startups, you're basically playing with lottery ticket. You don't have any statistical hope, realistic statistical hope of generating a required return. So buy lottery ticket, it's fun. You know, if you want to do that, it's okay, but it's not what I would consider a risk-adjusted, reasonable form of investment. Now, you might question about my 30x return number. Why did I say that in very early stage investment, we need to get 30x return? And this is another mistake that I wanted to highlight this morning. I call wrong cost of capital. And how do I get to that 30x return? Just, again, looking at the numbers. So VC cost of capital. VC cost of capital means how much should a rational investor expect to yield on their investment in an early stage venture capital fund. We look at the market is at least 25%, somewhere between 20 and 30%. This means the manager should be delivering 6x gross multiple over 10 years. With a 20% success rate, which again, remember, 20% success rate is being pretty generous, because we should have 20% investments delivering more than required return, delivering more than 1x, but required return is going to be delivered by a very smaller fraction of those investments, which means that in order for the VC to deliver the 25% per year that VC fund investors should reasonably require, their successful investments are going to have to deliver 30x return post dilution. And again, we also know that early stage investments are going to be diluted, and in most cases, they're going to be diluted around 50% from the original investment equity that the startup held. So this one, again, totally avoidable. And if you bring this back to my earlier discussion about valuation, you can see how it fits together. Because if we need 30x return post dilution, and we're valuing companies that are most likely to exit in trade sales, and if the most likely exit valuation at the trade sale is something around 200 million US, this means that current valuations should be somewhere between 1.5 and 3.5 million US, which we see a lot of violation of those general range of valuations in early stage investments in Southeast Asia. Next one, I call off-market deal terms. This is a surprisingly common mistake, and also again easily avoidable because we all know, or if we don't know, it's pretty easy to figure out what are off-market deal terms. On my left side of this slide, I show what are the most common off-market deal terms for the most common deal terms. And again, I have lots of more detail about this category of information for those who are interested. On my right-hand side of this slide, I pulled out some of my most favorite way off market terms. And the way off market terms usually come from newer investors or maybe some news, especially new CVC investors. But the point here is that a lot of these, when you look at a lot of the off-market deal terms, they have some important commonalities. The important commonalities are at a surface level, they might look favorable for investor. So the investor, some of these like, oh, okay, I'm going to say, and I think pretty much everybody that understands how VC works knows VC should always acquire minority stake, and usually relatively small minority stake, somewhere between 10 and 20%. It's most common. So some off-market deal term, especially newer investor or angel investor, they want to acquire controlling stake from day one in the company. And this might seem, oh yeah, well, it's economically favorable for me. If I can get a 51% stake, then why not? And that equity is going to be obviously worth a lot more than 20%. Wrong. It's totally, well, wrong, because of course 51 is more than, two times 20, but the equity will be worth nothing in most cases, because when you invest at off-market deal terms, which companies do you get? When you invest at off-market deal terms, you get the companies that have no better options, or either the company is clueless, the founders are clueless, or they're desperate. So you're investing in clueless or desperate founders who either have no idea what's a good deal, but by the way, the market will correct that later. So when the company needs to raise more money, the next round investors are not going to come in because the previous round terms were so bad. Or you're investing in desperate startups who can't get any deals with market deal terms, and then you have to wonder why. Why can't they? So either way, this strategy, if it's a strategy of off-market deal terms or the mistake of off-market deal terms, definitely will have a boomerang effect for the investor. And messy cap table. So this is one of my favorite and I think least focused on avoidable mistakes for VC investors. And again, this is one where even experienced investors, I think, sometimes miss out on this. We always look very carefully at the company's cap table. For those who are not familiar with cap table, it's a very simple explanation of who are the shareholders in the company, how many shares do they have, what are total number of shares, how much did they pay for each of those shares, and what was the class of shares that they paid for. And although this might seem like somewhat dry or not that interesting information, you can learn a lot, especially about early stage startups, for which we will have very limited other types of information. And when we invest in early stage startups, we're going to have very little historical financial data and maybe very little market traction in many cases, but we often will have, we'll always have a cap table, and we can learn a lot about potential problems in the company through the cap table. Some of the most common examples in Southeast Asia, part-time founders. So the founders are one or more of the founders, often the CEO, has started this company, but they're running another company. We could call sort of serial entrepreneur, but actually it's parallel entrepreneur, because they're still running the previous company. Now they're raising money for the new company. And this needs to be corrected before investment, because We don't want to invest in a founder who's running two companies when we're only in one company. This creates a irreconcilable divergence of interest because all our money is in company A and the founder has company A and B to fall back on. And sometimes I get the part-time founder saying, oh, but 99% of my time is on this company. That might be true. 99%, it's not 100%, still part-time. And also that can change over time. Maybe today 99%, but when situation changes, maybe now it's 1% and 99 the other way. And then sometimes part-time founders say, what about Elon Musk is running multiple companies? I say, yeah, definitely. If you're Elon Musk, you can do that. As soon as you're the world's richest person, then you can do whatever you want, and people are still going to invest. And I would also definitely invest if I had a chance. Inactive founders. These are situations where there's a lot of dead equity in the company. The next three, inactive founder, superstar, I call strategic advisor, venture builder, technology vendor. These are basically dead equity situations where somebody is holding significant amount of equity who's no longer either active member of the management team or key employee or a financial investor who invested at a market valuation. All of these are going to create problems down the road, and we need to clean these up before investing. Too many small investors. Some enterprising entrepreneurs have raised, let's say they raise $500,000, at $5,000 a piece. So they have 100 investors. This is way too many investors. Of course, that's extreme case, but we will see other variations on this. And that's going to be a nightmare in the long run. Needs to be cleaned up before we invest. This one can probably be solved with SPV, but that is something that should happen before the investment. And last one, FF&F, so friend, family, and fools investment. And the most common problems here are either poorly documented or undocumented investments from friends, especially friends and family. So these will definitely become an issue and need to be cleaned up before investment. So that brings me to the end of my slides for this morning. And I know I talk fast and I raise a lot of issues. I want to devote the rest of the time that we have to question and answer from you.